Welcome to our 2026 Tax Survival Guide. If you're watching this, you're likely feeling the weight of the calendar. For my S-Corp and partnership owners, your tax day is March 15th. For everyone else, the W-2 employees, the freelancers, LLCs, and C-Corp, your day is April 15th. Most people think they are running from a deadline, but I want you to start thinking about managing a balance, because as you're about to see, the IRS has a very specific set of priorities. Here's the secret most people miss. The IRS is a collection agency first and a library second. They care about the money far more than they care about the paperwork. Think about it. If you file your paperwork perfectly on time but don't pay a dime, they send you a bill with heavy interest. But if you pay your estimated tax on time and ask for 6 more months to finish the paperwork, they almost always say, no problem. Why? Because they already have your money. An extension is not an admission of guilt or a sign of a messy business. It is a formal pause button that tells the IRS, I'm paying you now, but I want to make sure the data is 100% accurate before I sign my name to it. Once you realize that the money is the priority, the fear of tax day starts to disappear. Since we know the IRS wants the money first, let's talk about the paperwork. If your books aren't ready or you're waiting on a 1099, do not rush. File Form 4868 if you're a freelancer, LLC, or W-2 employee. File Form 7004 if you are a partnership, S-Corp, or C-Corp. I'll put the IRS links to the extension forms in the description below. This gives you an automatic 6-month extension to file your return. By doing this, you instantly kill the failure to file penalty. That penalty is 10 times more expensive than the penalty for just being late on a payment. Even if you can't pay a single dollar today, filing this one-page form protects you from the most aggressive fines the IRS has. Now, how do you satisfy that money priority we talked about if you don't know exactly what you owe yet? You use the safe harbor. Think of this as a legal no penalty zone. Path A to get into the safe harbor is the 90% rule. The IRS says if you pay 90% of what you owe for this year, you're safe. The problem? Unless you have a crystal ball, you don't know exactly what you owe for this year yet. If you guess wrong by even a few $100s, you've missed the harbor and the penalties kick in. That is why I recommend Path B, the prior year rule. This is your fixed target. It's 100% of what you owed prior year. This number is already written in stone. Look at your tax return form 1040 from last year and find line 24, your total tax. If you are a C Corp, it'll be line 31. In your form 1120. Let's say that amount is $20,000. Between the taxes already withheld from your paycheck all year and any extra payments you've made, you just need to make sure the total adds up to that $20,000. If your employer already withheld $18,000, you just pay the remaining $2,000 by the original deadline. You've hit the target, you're safe. Now here's the catch. Path C. If your adjusted gross income was over $150,000 last year, the IRS wants a little extra insurance. Instead of 100%, you need to pay 110% of that prior year total tax. So if your line 24 was $50,000 last year, you need to have $55,000 in the IRS's hands by the original deadline. If you do that, it doesn't matter. If your business blew up and you actually owe $100,000 this year, the IRS cannot hit you with an underpayment penalty. You've reached the harbor. You'll pay the remaining balance in October when you file, but you won't pay a penny in fines. What if you paid $10,000 in March or April, but your final bill was only $8,000? You have $2,000 sitting with the IRS. You have two choices. Choice one, get it back. When you file your final return, even if it's in September or October, you'll fill out the refund section. You will find the refund section toward the very end of the form. One thing to note, the IRS has updated its rules for 2026 to push everyone toward digital and is prioritizing direct deposit. If you don't provide bank info, they may freeze the refund and send you a CP53E notice, which is their digital first alarm bell asking for it before they'll even cut a check. Choice 2, the roll forward. This is what I recommend for business owners. Instead of waiting for a check, you tell the IRS to keep the $2,000 and apply it to your Q1 or Q2 2026 payments. On the Form 1040, look at line 36. On the form 1120, look at line 37A. It's like a forced savings account that ensures you're already ahead for next year. Now, let's look at a more important scenario for today's topic where you realize you owe the IRS, but you just do not have the cash. Based on what you choose to do, the final costs differ significantly. Path A is no action. This is the most expensive mistake you can make. If you do not file and you do not pay, the IRS hits you with a combined 5% penalty on a monthly basis. On a $10,000 tax bill, that is $500 in pure junk fees added to your balance every 30 days. Now, the IRS caps that specific failure to file penalty after 5 months. Starting month 6, the penalty rate drops to just 0.5%, but the damage is already done. Add in the 7% annual interest, which is about $60 a month, and in just 6 months, your $10,000 debt has ballooned to roughly $12,910. You essentially paid a 29% penalty tax just for staying quiet. So do not even consider this an option. Next, let's look at Path B, the short-term plan. You file your return or an extension on time and apply for a 180-day short-term payment plan online. In this case, the plan setup fee is $0. The failure to pay penalty is 0.5% per month, which will be about $50 a month. Interest will be about $60 a month at a 7% rate. The total cost after 6 months is approximately $650, which is not bad given you earned 6 months of breathing room to prepare the money. Lastly, there is Path C, the long-term simple plan. It is similar to the short-term plan, but you use this when you physically cannot pay off the balance in 6 months. You can set up a monthly installment agreement via direct debit. In this case, there will be a one-time $22 setup fee. However, the failure to pay penalty is now cut in half to 0.25%, reducing the penalty to $25 a month. The interest stays the same at roughly $60 a month. Let's look at the reality if you take 10 months to pay this off. Over 10 months, you will pay about $250 in penalties and $580 in interest. Your total extra cost for stretching the debt out to 10 months is about $852. Now that you see how much a plan can save you, the next question is whether you actually qualify to set one up online. The IRS has strict limits on who can use their automated system without having to get on the phone and negotiate. And the rules are completely different depending on whether you are applying as an individual or a registered business. Let's start with individuals. This category includes W-2 employees, freelancers, independent contractors, and sole proprietors. To qualify for the 180-day short-term plan, your total balance, which includes the tax, penalties, and interest, must be under $100,000. If you need the long-term simple plan, your total balance must be $50,000 or less, and you must have filed all of your required tax returns. It is also worth noting that if you owe between $25,000 and $50,000, the IRS will mandate that you set up automatic direct debit payments from your checking account to get approved. Now, let's look at businesses. If your business operates as an S corporation, C corporation, or a partnership, the IRS leash is much shorter. Your business can only qualify for a long-term online payment agreement if it owes $25,000 or less in combined tax, penalties, and interest. Just like individuals, the business must be completely caught up on filing all past returns. And if the business owes between $10,000 and $25,000, that automatic direct debit is mandatory. If your balance is over these limits, or if you have unfiled tax returns from previous years, the online portal will lock you out. At that point, you will have to call the IRS directly or hire a professional to negotiate a custom agreement, which almost always requires submitting detailed financial records to prove you cannot pay. Before we wrap up, I want to give you a few pro tips that will save you from getting hit with unnecessary fees. First, always apply for your payment plan online and set it up as a direct debit from your checking account. If you apply by phone, by mail, or in person, the IRS charges a significantly higher setup fee. Also, if you choose to make your monthly payments with a credit card instead of a bank account, you are going to get hit with expensive card processing commissions every single month. Keep it online and keep it connected directly to your bank. Second, understand your minimums. For the long-term plan, the IRS usually calculates your minimum monthly payment by taking your total balance and dividing it by 72. However, you are highly encouraged to pay more than that minimum whenever you can. Every extra dollar you throw at the principal reduces the daily interest and monthly penalties you are being charged. And if you are considered a low-income taxpayer, the IRS may actually reduce or completely waive that initial setup fee, so keep an eye out for that waiver when you apply. Third, the IRS only allows you to have one active payment plan at a time. If you happen to owe taxes again next year, you cannot just start a second plan. You will have to revise and consolidate your new debt into your existing plan, which will cost you a small revision fee. Fourth, whatever you do, do not ghost the IRS once you are on a plan. Missing a monthly payment will trigger a costly default, leading to reinstated penalties and potential bank levies. If you lose your job or physically cannot make a payment 1 month, call the IRS immediately to adjust your plan before you default. Finally, please avoid third-party tax relief scams. You have probably heard the aggressive radio and late-night TV ads promising to settle your tax debt for pennies on the dollar. Many of these companies charge thousands of dollars in upfront fees to simply fill out the exact same online installment agreement we just talked about. You can do this yourself directly with the IRS for almost nothing. Okay, we covered a lot. Let's bring this all together for your final takeaways. If you realize you cannot pay your tax bill this year, your very first step is to always file your return or your extension on time. By simply filing that one piece of paper, you immediately stop that massive 5% failure to file penalty from draining your bank account. Next, pay whatever you can by the deadline. Even if it is not the full amount, every single dollar you send to the IRS today reduces the daily interest and monthly penalties you will owe later. Then, choose the right payment plan for your specific math. If you owe a smaller amount and can pay it off by the fall, jump on the short-term plan. If you need more than 6 months to pay it off, pay the online setup fee for the long-term installment agreement so you can permanently cut your monthly penalties in half. By using these official IRS tools, you are turning a massive tax crisis into a manageable monthly expense. If you are ready to make 2026 the year you actually take control of your money, hit that subscribe button. We are building a community of taxpayers who are not afraid of tax day anymore. I will see you in the next video. Thank you for watching.